Hey y'all, Zach McDonald, your real estate agent with Real Property Associates, and today we're gonna talk about down payments. There's a big myth out there that you need to put 20% down on a home purchase. And I think some people might believe this because that's what they've been told by some. They might have been advised to put 20% down by some kind of financial guru. They also might be thinking they want to avoid some kind of mortgage insurance or get a better rate. There are lots of reasons to put more than 20% down, but I think for a first-time home buyer and even for a second-time home buyer, I think it's important to know that you don't need to do that. You can, but you don't need to. Today, we're gonna look at what people think they need to put down, what people actually put as a down payment. We're gonna look at the type of loans most commonly used, and we're also gonna look at down payment sources. Before we jump into all of this, I wanna share some local information. I'm in Seattle's real estate market, and these numbers are national numbers, but when I look at the amount of cash purchases in the Seattle area, we're seeing about 15% in King County over the last year, and this is as of the beginning of August 2022. If we look at Snohomish County's stats, we're seeing about 12% cash purchases. Now, if we're looking at national numbers, which we'll be talking about here, we're seeing about 87% are financed, right? So pretty similar, but a little bit more in King County or cash, a little bit less in Snohomish County. And then for first-time home buyers though, nationally, 95% for a primary residence. So people buying investment properties aren't factored into the national equation. I will say in mine, it's not accounting for those numbers. So it's probably very similar and maybe even less cash purchases for those primary residents. But overall, we're seeing a lot of finance purchases versus cash purchases. So for a buyer, if you're thinking about buying and financing a purchase, your competition is not a cash buyer. And I think a lot of times buyers are thinking, especially when the market's more competitive, I gotta compete with cash. And there's a true aspect to that, but the majority of houses aren't going to cash buyers. So if you are up against a cash buyer, it is difficult to compete, especially if they're willing to pay the same price as a finance buyer. But in a market that's shifting like we're in right now, or even a buyer's market, you're gonna see less competition and it's even easier to finance. Let's look at this study now from the National Association of Realtors. And I think this is super helpful, easy to digest information. So in their graph here, and I'll put it up on the screen for you as well, they break down what people think a traditional down payment is. And the majority of people in their study think at least 15% or more, right? So it's a 16 to 20% range, 35% of people. 10% think at least 20% or more. So you've got 45% of people are thinking you're paying more than 15% down on your payment. What that means is more people actually think you can put less down, right? If we look at the total percentages. But I think the perception is that there are a lot of people that still think you got to put more than 15% down. So there's still a good chunk that think you can do 10%. In fact, 21% of the people kind of nailed the number that we're going to be talking about. As we jump down to the next graph, and we'll put this one up on the screen for you as well. This is the actual numbers that people put down. So the percentage of the down payment for, and it has on here first-time home buyers and also repeat buyers. So we can look back, and they started tracking this in 1989. You can see back in 1989, you had 23% down on average for repeat buyers and 10% down for first-time home buyers. It's ebbed and flowed over the years in the graph, but when we get to today, and this is as of last year, right? So coming into 2023, we should have some updated numbers here. But as of the end of 2021, 17% down for those repeat buyers. So again, repeat buyers are gonna have some equity, maybe a little bit more established in their careers. And then the first-time home buyers, 7% down. 7% down is the average. So I think for a first-time home buyer, and really for any home buyer, you don't need to put 20% down. And that's, if we look at the data, statistically, people aren't actually doing that on average. And so if you find yourself in a position where you're like, I don't have 20% down, I can't buy a house. Well, that's not true. In fact, the data shows that. But you also can put quite a bit less down and still be successful. So there are lots of factors when it comes down to, do I qualify? What are my monthly payments? All of those types of things, right? Because you've got to factor in personal budget. But that's a conversation for a loan officer, not for me. I could have that conversation with you here on the video. But I think, they're looking at income, assets, and credit. Those are the big three things, right? How much do you make? How much do you have? And then what's your credit score? And so those all help factor into, what your interest rate's going to be, but also what you can afford and what you qualify for. And that is dependent on the individual, but the amount you put down is something that you could, change. So you could put less down, more down. A lot of times people will put more money down so they can qualify for a better house, because that mortgage amount, the amount the bank will lend you, is not going to change. The loan amount won't change. You could get a smaller loan amount, but there's going to be a max that everybody has. At some point, if you want a bigger house, you're going to have to add money on top of that mortgage amount. So if you say, I want a $700,000 house, but you only qualify for a $500,000 loan, you got to come up with $200,000+ for your down payment and closing costs. But if you're willing to buy a $600,000 house, now you only need $100,000. So again, that's kind of how that math works. But the down payment size here, I think, is helpful to know. Another thing this study looks at are the type of loan programs used. So if we look at this graph, and we'll put this graph up there too, you'll see that the vast majority of buyers are using what's called a conventional loan or a conforming loan. This is not one of the federal programs, and so you'll see a few of those here as well. Overall, for all buyers, right, 69% here are using that conventional or conforming loan. 15% are using the FHA loan, a federally backed loan, and you've also have the VA loan, which is similar to an FHA loan in some ways, but only available for veterans. And there are some other nuances there. And then there are a few where they don't know, or other types of programs. There's some other ones that mix in there. But the most common ones are going to be that conventional loan, FHA, or the VA loan. And if we look at first-time home buyers, we're going to see that they're going to be relying on the FHA loan a little bit more, which is more of a low down payment type of loan. But you can also do low down payment conventional loans. So again, it comes down to the person's situation, credit scores, things like that, to kind of fit into those different loan programs. And again, I don't want to talk about the nuances of loan programs because I'm not a loan officer. I understand them, but that's not really my place. I just think it's important to point this out here. But the repeat buyers, interestingly, you'll see a lot less reliance on those government-backed loans, more in line with the conventional standard. What I've heard from loan officers and what I've experienced is that those conventional loan, if you can go that route, is usually better, unless you've got the VA benefits, right? If you got the VA loan's amazing. But a lot of times people will opt for the conventional loan if they can swing it versus that FHA loan. The last thing we're going to look at here in this study is the down payment sources and where are people getting the money for these purchases. And people ask me this question, right? All of these questions are questions that people ask me. But when we're looking at the down payment source, I think this graph's really interesting as well. And it's going to add up to more than 100%, so don't get stuck on that. Some people are using multiple sources, right? So if you're using cash and some money from your 401k, cool. That's going to both count for this graph. So again, this graph's adding up to more than 100%, but you'll see that a large majority of people are using savings for their down payment, 83%. 28%, this is interesting, gift funds from family. That's more than 25% of people are getting money given to them from a family member, relative, friend, somebody who cares about them and wants to help them out with a purchase. And a gift fund is not a loan. It's not a loan. Now, I think people probably pay back these gifts sometimes, but the way it works is when you have a letter, right? The way it works is you have a letter that is from the gifter, right, the grantor, to the grantee, and they are saying that this money is not money that they're obligated to pay back, right? It's a gift, not something that they have to pay. So I think there are people that are benefiting from this, and sometimes it is really more of a loan. All right, I've seen that. Like, well, I'm just going to say it's a gift. But again, that's not really my part of the ball game here. But the gift funds here are the second biggest source on this graph, which is a really significant thing to me. I also think it's pretty cool that people can help others out with a purchase. I'd love to be in a position to help kids and such with these types of things myself. I think if we're looking at the third thing on this list, sale of stock, I see it quite a bit. RSUs, options, things like that. People are selling to make those payments, come up with those down payments. So you'll see sometimes a combination of savings and then the stock. And then the pension, 401k type of deal. Again, a lot of first-time home buyers kind of leaning into that. And you can borrow against it. There's different rules and how it gets paid back and different rates and things like that. But again, 401k is a great place to draw from too. We've got savings, gift funds, sale of stock, and then also those 401ks or pensions where people are pulling money out for down payments. But I think overall, there are lots of different ways to make it happen. And if we get stuck on, hey, we only can do the down payment from our own funds, then it changes things, right? But if we can maybe sell something that we have, maybe it's a car, what the heck. Sometimes people pay off a car so they can have more credit, so that's not counting against them. Again, there's lots of ways to be creative with a home purchase, but I think for somebody who's thinking about buying their first house, you gotta be creative sometimes. And I think don't be afraid of paying less down to make it happen and just start building equity. In my own personal situation, we put 10% down on our house. We could have put more, but I was already kind of in line with all of this. And we put down 10%, and that 10% down payment was like $55,000. And it's become, now granted, you got to factor in all of the maintenance we've done to the house and interest we paid and things like that. But that $55,000 down payment with all those other things added on has become $500,000+ of equity. That's pretty amazing. Now, we could have seen that same benefit putting down 20%, but the 20% is sitting in the house getting me the same return as the 10% would have got. So that other money was able to sit in another place in the stock market and also grow in the stock market. So you're seeing the money kind of working for you in two different places instead of being all in the same place and getting you the exact same return. Because more money in your house doesn't equal greater ROI, right? More money in the stock market equals greater ROI, right? Because there's more money growing and increasing in value, but in the house is the asset and it's increasing in value. You're not getting more houses by putting more money down, you're getting the same house. In the long run, that lower down payment tends to make you look more like a genius than somebody who made a bad financial decision. And again, the misconception is you gotta put at least 20% down. If you don't, you're not making a good decision. I chose to put less than 20% down, but I'm pretty happy with that choice. Thanks so much for watching this video as we talk about down payments and debunk the myth that you have to put 20% down to buy a house. Now, not everybody believes that myth, but I think there are enough people that believe that it was important to make this video. If this video was helpful for you and you made it all the way to the end, please consider giving a thumbs up or dropping a comment. And if you know somebody who could benefit from hearing this video, please share it with them.